If you're looking to do business in Japan, there's a set of rules you absolutely have to understand. They're called transfer pricing rules. And believe me, getting them wrong can be an incredibly expensive mistake. So, in the next few minutes, we're going to break down exactly what they are and what you need to know. Let's jump right in.
So let's start with the big question right here on the slide. Why on earth does the Japanese government care about the price you set between your own companies? I mean, if your headquarters in one country sells something to your office in Tokyo, that's your business, right? Well, not so fast. When taxes are involved, it becomes everyone's business. And this simple chart really gets to the heart of the matter. Just imagine your parent company is in a country with a low tax rate, say 10%, but your subsidiary in Japan has to pay a 30% tax rate. Now, if you're a global company, you're going to notice that every dollar of profit you book in Japan costs you an extra 20 cents in tax. That creates a huge, and I mean huge, incentive to make those profits appear somewhere else.
And here's the classic playbook for how that's done. The subsidiary in Japan sells its product to the parent company for a ridiculously low price, so it looks like it made almost no profit. Then, the parent company turns around and sells that same product for the real market price, and voila, all the profit is now magically in the low-tax country. The result? The company as a whole pays away less tax, but Japan gets shortchanged. And this is exactly what transfer pricing rules were invented to stop.
So, how does Japan, and really most countries around the world, fight this kind of profit shifting? Well, they use a globally accepted standard. It's a simple but really powerful idea called the arm's length principle.
The arm's length principle is pretty straightforward when you break it down. It just means you have to price deals inside your corporate family the exact same way you would if you were dealing with a total stranger. No special family discounts, no sweetheart deals. The price has to be what two completely independent companies would agree on in the real world.
Think about it this way. When two strangers do business, the market forces a fair price because, hey, neither one wants to get ripped off. But inside a corporate family, you could technically set whatever price you want. The arm's length rule steps in and says, nope, that family deal has to look exactly like the stranger deal. This is how they make sure profit is taxed where the actual work was done, in this case, in Japan.
In the numbers on this slide, just make it crystal clear. Look at this. At a fair, arm's length price of 1,000 yen, the Japanese company makes a profit and pays its fair share of tax, 90 yen. But with the manipulated internal price of 700 yen, the profit in Japan completely disappears. And the tax owed? A big fat zero. You can see why tax authorities are all over this.
Okay, so we get the principle, but that brings up the next massive question for any business owner. How in the world do you actually calculate this arm's length price? And, just as important, how do you prove to the tax authorities that you got it right?
Well, Japan recognizes several official methods, and you have to pick the one that's most appropriate for your situation. These are the big ones, and the key thing to remember is you can't just pick the one that gives you the lowest tax bill. You have to choose the method that most accurately reflects the economic reality of the deal.
Now, out of all those methods, there's one that gets used a lot in Japan, the Transactional Net Margin Method, or TNMM for short. To put it simply, this method is basically a reality check. It asks, is the profit margin your Japanese company is making on this deal similar to what other independent companies make for doing similar things? If your margin is way lower, that's a huge red flag for an auditor.
Now, don't worry about reading all the Japanese on this document. What this diagram really shows is the core idea in action, a transaction flowing from a company in Japan to a related company overseas. It doesn't matter if you're selling goods, providing services, or even licensing your brand name. Any of these cross-border deals inside your corporate group are subject to these rules. Every single one.
So we've got the principle and we've got the methods. But now for the part that really matters. What happens if you get this wrong? This is where the theory stops and things get very real. And the financial stakes, they are incredibly high.
This isn't just a scary story to keep you up at night. This number, 22 billion yen, was a real penalty. This was a transfer pricing tax assessment against Honda back in 2013. A number like that can do serious damage to a company's bottom line. It proves that getting this right isn't just about ticking a box for compliance, it's about fundamental risk management.
And this right here, this might be the most important rule of all.
It's called presumptive taxation, and what it means is, if you can't prove your pricing is fair with solid, concrete documentation, the tax authorities don't have to argue with you. They get to decide what the price should have been and then tax you on that number. The burden of proof is 100% on you, the taxpayer.
So how do you meet that burden of proof? It all comes down to documentation. These 3 documents are your shield in an audit. The master file gives the big picture of your global business. The country-by-country report shows where you make money and pay tax. And the local file, that's the crucial one. It's the detailed, nitty-gritty evidence for your specific transactions in Japan. And you can't just whip this up on the auditor's call. It has to be prepared at the time of the transactions.
Okay, we've covered a ton of ground here. From why this is an issue in the first place, to the core principles, to the pretty scary consequences of getting it wrong. So let's pull it all together into a few key points you can take with you.
Let's just boil it down. First, know that Japan's tax authorities are laser-focused on this. Second, every single transaction between your group companies has to follow that arm's length principle. Third, you have to be ready to defend your pricing with a solid calculation and, most importantly, the documentation to back it all up. Because fourth, as we've seen, the cost of being unprepared is just massive.
And that brings us to the final critical question you need to ask yourself. It really isn't a matter of if your pricing will get looked at, but when. Being prepared isn't just about avoiding a huge penalty, it's about building a solid, sustainable business in Japan. So, is your strategy ready for that scrutiny?